Hey traders, Jeremy here, coming at you hot on Monday, February 20th. I am posting this video for our weekly prep video for the week coming up here, Tuesday through Friday. Thank you, presidents, for President's Day here, giving us a day off with the markets closed so we can just kind of hang out and gather our thoughts a little bit more for the week ahead. Going to be an interesting week. It is at a battle zone right now. We're looking at the S&P futures index, and you can see that while on a longer time frame chart, it hasn't really done anything wrong. On the short term, price action did close below the 20 period SMA for the first time, really since the beginning of the year, like January 5th or 6th, somewhere in there was the last time that we actually closed and were still below that 20 period moving average. So on the short term, it seems like bears might have a slight edge. That said, we are still holding on around that, couple of support levels we've been talking about. The one line in the sand at the lower level is that 4,000 mark. That's all the way down here and actually coincides with the rising 50 period moving average seen in red, as well as our longer term diagonal resistance line. So I actually wouldn't terribly mind it if this price action continued to sell off. We saw stabilization for a few days or a week or so down here on top of the 50 period moving average, touched off on the diagonal, and then started to move higher again. It'd be a little deeper than I would like to see, but at the same time, it would represent a low risk entry because we would know pretty quickly here if we were wrong and could have our stop losses in place to get out if it did roll against us. So I do enjoy finding setups where there is a limited amount of risk associated with it. If we push this out to the weekly chart real quick, not the daily chart, there we go. You can see that this really hasn't done anything wrong. It is just consolidating. We had gone up quite a bit. We went up from 3,800 all the way up to above 4,200 in just a few short weeks. So it makes sense that the market would take a breather, chill out a little bit, retrace, give back some of those gains, consolidate, and then try to make another leg higher. So I don't mind the pullback right now. On the weekly, I actually like it even more, especially because we are still above and kind of pulling back into currently the rising 9 EMA, the exponential moving average. And we also have the 50 period simple moving average below it that is starting to flatten out here. And again, coincides with our rising diagonal support line here. So I'm actually not too concerned with the bearish action currently, as long as it stays above that 4,000 mark. And I'll actually adjust that up slightly. I'm going to say 4,020 mark because I do want to see prices stay above this rising this declining or flattening 50 period SMA. If it breaks down below that temporarily, tests the 4,000 mark, but then closes back above that on the weekly chart, I'm fine with it. But if it closes below this line, to me, that signals there's more bearish pressure coming in. This last week, we did have a whole slew of economic data that came out showing that there's a good chance that the Federal Reserve is going to keep interest rates higher and potentially raise them more for a longer period of time than most market participants were expecting or want. So that's not particularly great information to be having. That said, we did also have some strong economic data that showed that in the face of inflation, our economy is doing just fine. So that kind of supports the fact that the Federal Reserve has more room to raise interest rates without crushing our economy. And so it's kind of one of those good news is bad news kind of situations in that vein of thinking. Now, while we're on this chart, I want to drop back to the daily chart and I want to introduce you guys to a tool that you have available to you in most trading platforms. So this is going to be the Fibonacci retracement tool. And I really like this tool because it shows the depth of pullbacks based on Fibonacci numbers. And if any of you guys aren't familiar with Fibonacci numbers, the short version was that Fibonacci was given credit for introducing the mathematical sequence of numbers where you add the previous two numbers together to get the next number. So you have 0 plus 1 is 1, 1 plus 1 is 2, 2 plus 1 is 3, 3 plus 2 is 5, etc., extending out onto infinity. And then there's a mathematical relationship between those numbers that you can then use to calculate these specific percentages that you see here. I know there's a lot on my screen, so you can kind of see them here. I'll zoom in. 0%, 23.6, 38.2, 50, 68.1, 78.6, and 100%. So those might seem like weird percentages, but they are based on this mathematical theory of the Fibonacci sequence. And it's just absolutely fascinating because these numbers show up in nature all the time, in architecture, in all sorts of things that humans do, including trading, and they tend to play out over and over again. It's not a coincidence right here that this week's price action pulled back and found support and bounced right at that 38.2% level. That is a fairly standard retracement level. While 50% and 100% are not technically Fibonacci levels, they are always, or pretty much always, included in Fibonacci analysis, just simply because they are those round whole number type situations that fascinate humans, and we just kind of gravitate towards. So a standard retracement is considered anything to the 38.2 and then down to the 50% level. So if we're looking at these two levels, that basically sandwiches our moving averages on the weekly chart and sandwiches that 4,000 to like 4,040-ish level on the chart that we've been talking about for so long. So even if we did have that price action pull back into that level, I wouldn't mind it because that would still be a standard retracement. And anything above 50% in terms of a retracement percentage, or excuse me, lower than a percentage, because the percentages decrease as you go higher in price, I enjoy, because that means that from the last run, from all the way down here at 37.88 to all the way up here at 4,200, basically, if we retraced back down half of that, we would have given up half of that previous run's gains, but not more than that. And that's important because in any bullish environment, you want to see increasing momentum to the top, or at least stable momentum to the top. And that 50% level is kind of a key level in that regard, to make sure that you are moving up, taking 2 steps forward, 1 step back, 2 steps forward, 1 step back. That's fine. You're just walking up the staircase at that point. So anyways, summing up on the S&P, anything above 4,000, as long as it stays above 4,000 and closes above 4,000, I'm fine with. If we do get that deeper retracement, I want to see some consolidation before I would end up wanting to take a trigger. But where the prices currently are, we are going to see a battle here between bulls and bears. We do have a little bit of economic data coming out this coming week, just a couple of different reports, and I'm honestly not anticipating them changing the story a whole heck of a lot from last week and from this breakdown of the 20 SMA. I think we're in kind of a technical environment right now where we really have to just see these support levels play out and hope that the price action holds and be prepared for if they don't. So with that said, I see short-term lean slightly to the bears until we get back above this 20 SMA. That is kind of the summary. Now, one thing that I want to point out, you can look at these two indicators, and this is the AR high and low for 3 months. So this is a indicator that basically looks at thousands of stocks and then looks to see how many of them are trading at new 3-month highs and how many of them are trading at 3-month lows. It subtracts those out, gives you the difference, and basically anything above 50 is considered bullish, anything below 50 is considered bearish, and you want 2 days worth of close on one side or the other of that before you take a trigger. So let's zoom in on this and just look really quick at the last signals that we had. So back here, we were kind of chopping around between these two signal lines. And then finally on 1/6, so January 6th, we started to get that bullish movement. And on 1/9, it really confirmed and took off. So let's just say 1/6. And then over here, we came back down and broke down into the neutral zone again on 2/6. So we had from 1/6 to 2/6. So now let's go out to the S&P And let's see how that bearish and bullish signal translated to price here. So this is the change of the year. So 1.6 was right here. Oh, let me get off my Fibonacci. So 1.6 was right here, and 2.6 was right here. So you can see by looking at not only the bullish momentum and breakout zones on the S&P, but comparing that to the AR high-low indicator, it can tell you when to be bullish and when to maybe take profit off the table and go bearish. And again, it went bearish right here. We consolidated for a little bit and then we broke. So that ended up being a really good secondary signal here to look at for which direction we need to have our bias leaning. Just to go through a couple of the other indexes here real quick, I want to keep today short. Bitcoin continuing to wake up. It's a little bit of a messy chop. I would have liked to see this high base a little bit lower down here, but we're getting a high base where it's going to give us a high base. I'm probably not interested in playing Bitcoin directly on this. I'm going to be playing some naked puts or something like that on some of the different stocks that track that, some of the Bitcoin proxies like Bitto or Mara, things like that. But it is interesting that this is waking up. And if we throw this out onto a longer term chart, that is a pretty nice setup, a nice head and shoulders, inverted head and shoulders pattern here, pressing up against the 50 period moving average. That's a nice setup. If I had a little bit more risk appetite right now, I might end up playing that directly, but I think we need to see the risk appetite in the market play out a little bit here this week. And Bitcoin's Bitcoin, so it will probably run or drop significantly before we get that action to play out on the broad market. So probably not playing this directly, but just wanted to call attention to it because it is a really nice looking setup developing there. On crude light, and we are still on the weekly chart, really nothing to see. We have a slight increase in support, but we are kind of in this choppy wide range mess between 70 and 82.50 or 83. Not super interested in playing that in between those two levels. A very aggressive trader might try to trigger here around 78 or 79. But there's just too much chop and too much nonsense to the left of the chart here. So I'd probably skip that. Ethereum looking really similar to Bitcoin itself. Gold had a much deeper retracement than I would have liked. It's now below its 50 period moving average, below its decreasing 9, and the 20 period moving average has rolled over as well. For me to be interested in this, it really has to get back above the 50 period moving average and consolidate a little bit, maybe give a little high base or something like that. I don't think gold is dead, but I think it has a while before this is going to be interesting to me again. Copper is actually looking really nice. Copper is breaking out here today, and I actually missed the trigger here that I was hoping to use. So this is another Fibonacci tool. This is a Fibonacci extension tool. And just a brief lesson on this, since it's already on my chart, you draw from the pivot low to pivot high to next retracement low again. And then it draws out the same percentages, but projecting an extension of price up into the future. A lot of traders use the 23.6 level as kind of their breakout level to trigger into a trade. And that actually coincided perfectly with the high of this hammer candle here, breaking out of the consolidation that you see here. So had I been in front of my computer yesterday when the futures opened on Sunday and that triggered, I probably would have taken that trigger on copper futures or on some kind of copper instrument. But it's run a little bit too much for me here, especially to play on futures itself, because the copper futures are incredibly leveraged. So unfortunately, I'm probably going to just be watching this one. My guess is we're going to see it come back up to the 50% level on the fib, which corresponds to the resistance here. That's a logical next step. From there, who knows how high it might go. This is being fueled by China reopening. China is a huge, huge consumer of copper. So it has a nice thematic backing to it, as well as a nice technical pattern. Natural gas, nothing to see here. Still just getting absolutely killed. The NASDAQ, similar read to the S&P, breaking below its 20 SMA. It needs some time to clean itself up. It did end up breaking its diagonal support there, so it is below its diagonal support, whereas the S&P was still above its long-term diagonal support there. So a little bit of a mess here. Need to see that cleaned up. Platinum, palladium, neither of these really have anything interesting to me. The Russell 2000 is interesting here. It hasn't done anything wrong. It is still trading above its 20 SMA, although barely. It is sitting right on it and has been just grinding on it for a week or so now. Do want to see it hold above that, so I'm actually going to go ahead and set an alert here at the low of today's candle to let me know if that ends up breaking down. Because I want to know if this ends up breaking, especially since it is the most constructive chart still in the major indexes and still has been clinging on to its diagonal support there. So we want to see that hold. Would be looking at a trigger above the two candles here. So around 1970, 1970, 30, somewhere right in there would be a potential trigger higher. But I think we're going to need a couple of days to get that, depending on what's going on with the economic reports that we have this week. Second to last here, silver firing off the lows a little bit, still below its 9 EMA, so not super interested. But I do have an alert set to let me know if it gets above its 9 EMA here, because I think this is overextended to the downside. Our RSI here, relative strength index, is confirming that it is oversold. And we have our MACD here that is starting to turn up and crossing over its signal line here. Still obviously in a downtrend on the MACD, but this is about to cross over. So if we do get a break above that 9, might be interested in playing silver via SLV, the index ETF for it. But I'll have to check the chart and see how that looks. And then finally, as we're wrapping up here, the Dow Jones Industrial Average. Really nothing to see. We are in kind of a longer term neutrality now, going back all the way to November of last year, waiting to see a break above that level or coming back down and breaking below here. Until that happens, not really interested in a whole heck of a lot. It's kind of just taking time off. And it's allowed to take time off after going up 23% in 2 months. So nothing to see on the Dow Jones. Other than that, guys, I think that's kind of a wrap. Looking for some breakouts and some possible retracements and stuff. This week, I kind of like JP Morgan setting up here. Drop that into the daily chart again for you. Nice breakout here above 144 and change. Mo, I really like. I don't usually trade this stock, but that is just such a nice setup, and we really have room to run back up to, I don't know, somewhere between 51 and 52 on the daily chart. We can back that out to the weekly chart. Yeah, nothing to see there until about 51.25 or so, coming back up to the pivot high here and the resistance over there. So I'd say, let's say target 51 on Mo. STX, high basing on weekly chart, holding above its 50-period moving average. And I like the trigger above the diagonal resistance line here, or if we get rid of that, triggering above the high of 73, 74, 73, 75, somewhere right in there. If you want a little bit more confirmation, see that running up to about 79 before it turns around. So anyways, just a couple of quick charts to put on your radar. Apple's actually also a little intriguing to me. Has a little bit wider range than I would like here, but a trigger above this candle's high over here around 157 or 158 makes some sense to me. Looking higher to 165 by 170. So just put those on your radars. This one is a little overextended. It probably needs a little bit more time to kind of tap dance here between support and resistance. So I'd like this to develop a little further throughout this week and then break out maybe the following week for me to be super interested in Apple, just because it does look like it's overextended. Anyways, have a good day, guys. I hope you have an enjoyable trading week. I hope this was helpful and educational for you. Smash the like and subscribe button if you are watching this on YouTube. Would really appreciate the support. Have a good week, guys. Take care.